Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast presented as always by Tusk Media. Real quick, show some love, subscribe on iTunes, unsubscribe, then resubscribe, helps us out a lot. Download some of our previous episodes. We have all kinds of stuff there, topical conversations, stock analysis, whatever it may be. Go through our archive, check out what we got there, and download the audio. If you're watching on YouTube, thanks for being here. Hit subscribe, that helps us out a ton. If you're on Seeking Alpha, follow us and leave a comment, show some love. And tell us what we did a good job of, what we did a bad job of, and what you'd like to hear more of or see more of. And we appreciate you being here. I'm Andrew Hall. Joining me, Ben Nye. Ben, how are you?
I'm doing well. Just coming off of lunch. So
big lunch. Just threw down some serious Laredo's Mexican Grill.
Yeah.
Unpaid endorsement right there of Laredo's in Kennesaw, Georgia. So pretty ferocious meals that we took down just now. So bear with us as we may be a little bit groggy. We're going to talk today about really some portfolio management tactics. A lot of times we do stock analysis, maybe we do some macro trends, take a look at things. We're actually going to talk about tactical day-to-day, really year-end portfolio management. In particular, we are going to talk about harvesting losses within portfolios and the benefits of harvesting realized losses in stock portfolios in particular. So we're going to talk about that. We're going to mention a couple of names along the way. Most of the names we mention are going to be positions that we either own or used to own because we're actually going to share this video with our clients so they can kind of see some of the stuff we are doing in those portfolios. So jumping in right off the bat, when I talk about harvesting losses, Ben, probably doesn't sound very good if you're an untrained investor.
Right.
Why would I want to harvest and capture realized losses?
yeah, well, it's the epitome of buying high and selling low, right?
That's right.
Investing not 101. But one reason is because when you sell a stock at a profit, or you have dividends or income that comes through over the course of a year, you have what they call capital gain. And what you want to do, you don't want to incur capital gains and then have to pay taxes on it. So what you do, at around the end of the year, a lot of people who manage money, manage their own money or manage other people's money, looks through portfolios in order to minimize the taxable liability. And a way they can do that is by selling the losers, the ones that they did buy high and sold low, in order to offset the ones that did well. Mm-hmm. So this reduces the overall tax liability and reduces what they have to spend in taxes the next year.
Yeah, so exactly right. What we're looking to do is minimize capital gains and therefore minimize the tax that's being passed through on those gains. You know, we talked a lot about this during the election season. Taxes were very much politicized, and we talked about how we were very much on the same page as Donald Trump on maybe one issue more so than any other issue, and that was we felt like he was completely right and savvy to do everything he could to pay as little tax as possible. Right. And at the end of the day, we very much agree with that. We don't think anyone out there should pay any more tax than they have to, as defined by the law. Don't take everything we are saying as the law. Talk to your CPA, your accountant, your investment advisor, whoever it may be, to find out. But these are some strategies that we do employ. A couple notes about tax loss selling, both this individual year as well as in general. It's been a little bit challenging this year.
Yeah.
It's harder if you want to think about it and visualize the market. When the market has just basically been running up, going this way, really since 2009, you don't have as many unrealized losses to then convert to realized losses right. And then offset gains. So that can be a bit of a challenge, if you want to think about that. The other way is if the market crashed and was down 30% right now for the year, we'd have a lot more positions that we'd feel comfortable being able to sell because there'd be more losses kind of across the board. So it becomes a little bit challenging to find those, and that's really the case right now. Other things I think that are important to note, this does create opportunity on the other side. We're not going to talk a whole lot about the opportunities, but sometimes you can actually find some positions to get in. Let's say a company is down 20% for the year. More and more people may start dumping that in the latter half of November or even into December. So you may see a company go from being down 20% to being down 25 or even more percent just because people are harvesting losses and nothing's really changed about the company. They could actually be doing a lot of good things. They haven't updated earnings or guidance or anything like that. you could really see that kind of start to spiral. So that's another thing to keep an eye out for, is just buying opportunities as those present themselves. But ultimately, the last thing I'll do before we jump into some examples here is I will point out that I think it's sometimes crippling as a portfolio manager or challenging to harvest a loss, because even though, you know, theoretically and mathematically and from a portfolio and client basis, this is a beneficial thing to do, it can a lot of times feel like an admission of guilt. Kind of feels like, oh, this didn't work and now I'm accepting failure. The one thing I would encourage everybody out there to do is take a step back, realize what the actual financial impact is, and realize, hey, if I can harvest this today, there's no reason I can't come back to this stock later. There are some restrictions. You can't turn around and buy it back tomorrow or anything like that. But it doesn't necessarily mean that over that waiting period, that blackout period, so to speak, before you can re-enter, it doesn't necessarily mean you're going to miss an opportunity.
Which is, it's only 30 days,
yeah.
too.
So, you know, think about it right now. If you really believe and are convicted in the stock and it's down 20%, to use the example we used earlier, how much of that upside do you think you're going to miss out on over the next 30 days? And does that outweigh the amount of tax benefit that you could harvest by getting that loss? So that's kind of the way to think about it. So don't get crippled by the fact of, you know, you're not throwing up the white flag permanently.
Yeah.
You're trying to make a savvy move here and help out the client. So a couple of examples of different types of harvesting we've been doing in our portfolios. One is what we kind of call intra-sector rotation. In this case, what we're talking about is we're finding similar companies within the same investment sector. We're dumping some losers and we're rebuying into positions that we're comfortable buying in general, and we're being able to maintain some of that allocation, not just within equity, but also maintain it within that sector. So some examples in the energy space, in particular in the MLP space, we've been selling some PAA, which is Plains All American, as well as Spectra Energy Partners, SEP for some clients. So we've been rolling out of those, taking those losses, and then redeploying assets in other places like EPD, some other names across the board. So really the benefit there is you're not switching the composition of the portfolio much. Ben, do you have any other thoughts on kind of keeping things tight in the sectors?
Yeah, because it can also be, you know, what you touched on earlier, it can be pro-cyclical. So when you're selling something that's already losing, like, you need to be what investors like to do is they want to buy when other people are selling, not when. So if other people are selling and you're selling, and then now you sell again, that's not typically what you get taught. But in this case, it does make sense when you can minimize that tax liability, which can be fairly significant. If you have a very low basis in a stock, let's say you have a $20 basis in a stock that's $100, that's going to be an $80 tax liability, which you have to report as capital gains, depending on how it might be short term, it might even be long term. But that's $80 in tax liability. So you really want to offset that, and this can be a really good way of doing that. And when you switch within the sector, you don't miss out on as much of that rebound. And you can feel a little bit more intellectually honest.
Yeah, and I think it's a great way, sticking within the sectors, to review your sectors and review individual positions. So, you know, sometimes you'll see kind of a widespread sector. I know a couple of years ago you had energy, for instance, across the board was just down because the price of oil was just falling. So almost everything in energy was a loser, but it gave you a really good excuse to say, hey, I can almost start from ground zero with this entire sector, because I can now go in and I can prioritize, hey, here's what I like the least. I'm harvesting those losses, and here's what I like the most. I'm going to try to buy, hopefully, towards the dip on that. So it kind of gives you an opportunity to do that. Another example of tax loss selling is really kind of these situational harvests. And what I mean by that is, especially on an individual client-by-client basis, when you're looking at folks, everybody's tax situation is different. They may be more or less tax sensitive based on their own income, or even just their own view of taxation. We have some clients who have a very, very firm anti-taxation view. Nothing wrong with that. We're going to try to get them as close to zeroed out as possible. But so this is kind of where you kind of dig in. You have to know your clients. Some examples here that I have done in portfolios that I'm the lead on or that I'm managing. Recently, I had a few clients that actually had losses in BUD, BUD, so was able to harvest some losses there because they specifically need them. Another example is Ford. Now, BUD and Ford are also companies that we're actually buying. for some folks in real time. So it may look, to our compliance officer, it may look like I'm taking an opposite action for different clients. But the reality is, I know, hey, the outcome of Bud, for instance, over the next 30 days, or Ford over the next 30 days, that's not as important as harvesting this losses to the client.
It's an economically different proposition depending on which client,
Right.
and depending even for a client which account it is.
Mhm.
Because in some instances you might say the client has an IRA,
Right.
which is not taxable, and a cash account, which is taxable, then you might want to harvest a loss in the taxable account and then actually buy that same security in the IRA, and that way you still have the same position but in a different account.
Mhm. Another strategy we do very similar to that, you mentioned, kind of taking a position, doing one thing in one type of account, another in another. Another way is taking a general investment theme or an asset class and rotating what you're actually doing. A great example of something we use a lot here is gold. So with gold, we buy often iShares or an ETF for gold ownership. And so sometimes what we will do is, let's say we own GLD, we will harvest a loss in that and roll into IAU, which is basically a comparable investment vehicle, but it's got a different ticker. It's a different investment vehicle. We can actually roll into that a little bit quicker. We don't have to wait on that 30-day window. So for a lot of clients, maybe we say, hey, we want to make sure that 2% of their portfolio is gold, or 1% or 3%. If we totally eliminate that whole position just to harvest a loss, all of a sudden they're really out of whack. They're high on cash. We don't necessarily want to deploy that back into equities, especially right now with the market hitting all-time highs. Maybe we're seeing challenges on the fixed income side. It gets really frustrating, but all of a sudden, hey, good news, I can actually keep it in that same bucket.
Right. And the thing you got to watch out for there is that it has to be substantially different.
Mhm.
But in the case of IAU and GLD, you're dealing with a different counterparty.
Right.
And you might have a different view of, is Spider or iShares a better counterparty to use. And for us, we don't express a certain view on either of them in this instance, especially when you're weighing it against the taxable, effective taxable asset that you have from
Right.
harvesting that loss.
Mhm. Yeah, so it kind of gets into the finer points there, so to speak, and I mean, even down to things like management fees.
Right.
You have different fees being taken out of those two instruments. So that's an example. The last one I think we'll touch on for today is kind of the bleeding stock or the opportunity stock, depending on how you look at it. And I think Teva is really a stock that's kind of right at the crosshairs
Yeah.
of this. For a lot of clients, we've been harvesting the loss on Teva, but at the same time, as it continues to trick down and more people kind of continue to push it down by selling, by harvesting that loss, it also starts to get into the opportunity where it's a real buying opportunity for other clients. So that's another one where you got to kind of keep an eye on it. You want to make sure you're not selling it and then rebuying it for the same client, because all of a sudden you're doing away with the tax benefit. But that's an example of a company where you're really seeing this trickle down. You get an opportunity to get out, but at the same time, you may be actually reevaluating that stock completely for other people along the way.
Yeah, there are a few in the pharma area. The Gilead too
Yeah.
is a big one. But then also you look at GameStop, and this is one that we actually in some accounts, we took the loss, but then in other accounts, we saw that there was an opportunity here that was presented, because after we actually took the loss, I think it went down even further, and so we saw an opportunity. There wasn't really any more new news out on it, so we decided, this is probably a decent trade going through the end of the year.
Yeah, so the big takeaways here, number one is just know your clients. Talk to them about their view on taxes, make sure they understand what they are looking at and what it means. And I think clients view things differently. Some view the amount of tax dollars that are owed. Others view things as their after-tax dollars remaining in the portfolio. Those are two really different things. And I think sometimes if you don't ask that question, what matters more to you, the amount of tax you're paying or the amount of money left in your account after taxes? If you don't directly ask that question, sometimes you can be on a different page than your client. So make sure you're doing that. Make sure you stay proactive. Make sure you refresh those realized gains data every day. And the last thing I would say, just to portfolio managers or clients out there who are looking at their own portfolios, be aware that you may be a little more active this time of year than other times of year, but try to stay tight on your asset allocation. If you're selling something, make sure you're trying to rotate into something that you want to buy. If you're making a macro call to reduce equity at this time and you're selling some equity, then great, two birds, one stone. But if your intention is not to reduce equity, make sure you're finding opportunities to buy in, because you don't want to sacrifice the value of a portfolio just to harvest a tax loss. I think that's all we got. Thanks for being here. This is the Investing Podcast. We'll talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.